Hey everybody, welcome back. Now part two of our episode. Hopefully everyone saw part one, the policy side. Now moving into profits and the S&P 500. On the market side of this, so all I hear from you is we have somebody juggling knives on fire while they're ice skating. That's basically what I mean. I hear as we're talking about, and I watch Powell, and I'm really not trying to be funny, but that's essentially what we're saying. That's essentially what we see. I mean, I live in a world of trying to quantify risk and quantify moves and profit from them. And when I watch what's going on at the Fed, I feel like it is literally, it's helter skelter. It's just they're doing within the Fed, they're counteracting their actions, which is insane. But then if you take what's happened in the previous administration, you could argue that the Fed within itself was fighting itself, and the Fed and the Treasury were both moving in different directions at the same time, or seemingly in different directions at the same time. So there's a lot of tug of wars going on. There's a lot of confusion, it seems. And what we're essentially trying to do is keep wraps. We're trying to keep, the Tasmanian devil inside of the box. That's essentially what we're doing. Tom Lee was on CNBC, and this is part of a view on Wall Street. It's a pretty broad stroke view, broadly accepted view, and in my opinion, part of the problem. Tom Lee was on talking about the move from QT to QE. I wanted to go to that clip and then talk about that for a second.
I think the biggest tailwind that's going to emerge in the next couple of weeks is around the central bank. The Fed is set to cut in December, but also today is the day that quantitative tightening ends. The Fed's been shrinking its balance sheet since April 2022. It's been a pretty big headwind for market liquidity. The last time we had an end to QT, quantitative tightening, was September 2019. And if you look back at that period, the markets really responded well. I think within 3 weeks rallied more than 17%. So I do think the timing of QT ending, which is now essentially QE starting, and the Fed, and at a time when November kind of was topsy-turvy, so I think people got cautious, but now have to performance chase, and then you have a really typically a seasonal tailwind. So I'm pretty bullish into December, even with maybe the first day being rocky.
All right, so the bullish into December, 7,000 to 7,200, 7,300 in the S&P, fine. He's talking about Bitcoin going above 100,000. Like, those are kind of different conversations versus the conversation, which is the longer-term conversation and point of QT to QE. There was a positive market reaction coming out of the move to quantitative easing in 2019. We saw 65 or 70 or 130 consecutive all-time highs achieved in the S&P. And then what happened? Well, for different reasons, but what happened 21 into 22 is we saw a very abrupt 30%, 27% sell-off in the S&P. Yeah. So I guess my question here is, my view is that we continue to kind of feed off of and look for the Fed to provide juice and gas to our equities markets and our risk markets. And that continues to create, and we have a chart coming up at the end of the show, which is, I think, pretty outstanding, that shows exactly what I'm saying. We continue to create this boom and bust market economy. We continue to create, to falsify and smokescreen what investors / traders / gamblers are doing. And it's a very dangerous game, in my opinion. If we go back to that QE argument, real quick, EJ, his argument is essentially this injection of liquidity from the Fed is going to be the beginning of the next tailwind for the S&P. Is that a new cycle? Are we halfway through the cycle? I don't know exactly where he stands on that, but if we're talking about a move up through 7,300 on the S&P and a tailwind being put in place, do you believe that the risks of going another 10 to 20% higher in the market are reasonable based on the risks of why we're going, or we think that tailwind exists? So in other words, is QE for real, or is QE the spot where you kind of really should be keeping your eye on the ball, because this is not why we should be looking for a 10 to 20% rally in the market? My opinion would be the latter. This is not why we want the market to rally. It may rally, and we'll be there if it does, but the end of that road is basically a cliff. So everyone's going to sprint there as quick as they can and then fall off. I see that as as where we stand based on this argument. Do you agree?
Yeah, Anthony, I mean, at the end of the day, you want the market to go up because of fundamentals, right? You want companies to be leaner and meaner and more profitable. You want us to be making more stuff, providing more services. That's why you want profits to go up. You want them to go up, in other words, in real terms, not just in nominal terms. And when the Fed goes on these buying sprees, the boom bust cycle that you just mentioned, you're absolutely right. That's all you get. You get a nominal increase, but you see prices for everything go up. And so you're not seeing an increase in relative prices. That's the big problem. So when you do get QE, we can expect markets to go up. I think that's absolutely true. I mean, you can point on one hand, literally, the number of times in the Fed's entire history of over 100 years when they were, pumping money into the economy and you did not have equities go up. I mean, it's that tightly correlated. Look, the markets are addicted to cheap credit. There's no other way to put it. This is why markets hang on Powell's every word, right? They want to know when, even if it's just 25 basis points, when's the next cut coming? It's like a junkie, like going to his dealer asking for another hit or something. And one thing that I think is important, though, to clarify, something that he said. He talks about how the market rallied only like 3 weeks after QT ended in 2019. Yes, that's true, but it's because the market wasn't just rallying because QT ended. It was because QE started. Right. In 2019, we were just talking about this. That's when that repo crisis happened. The Fed didn't just stop QT. They immediately went into QE. That's not what they're doing right now.
Okay.
We've talked a lot over the last few months and actually the last couple of years about what the reverse repo market was telling us and what was going to happen once that facility ran dry. And it was not a matter of this is cataclysmic, it's the apocalypse, the sky is falling. We never did that. What we said was this is going to force the Fed to make changes, and it will. Okay. It's just not doing it immediately. It's not as if as soon as this happens, the Fed has no other tools, right? They're still going to use the regular repo market, the standing repo facility that was created because of the 2019 autumn crisis. And all of those mechanisms are working as intended. And it won't be until those things are maxed out that then the Fed starts QE. So QE is not happening today. It's not happening this week. It'll probably be in the coming months. And I think that's when you'll really see that upward pressure on equities.
Okay, now I'm going to pause there. I'm going to ask you one question based on that. Powell is leaving office, his seat in June?
May.
In May. So would the replacement of Powell then, based on what you just said, potentially be an incremental negative to equity valuations if the replacement comes in more level-headed as far as how we need to manage the balance sheet and quantitative easing versus not? Powell's already shown himself to be led by the market and already shown himself to be biased with what he wants to see the outcome to be, not necessarily what the right policy is. Right. Could we potentially see a Federal Reserve chair come in that could be a generally a positive, but a net negative for equity valuations?
So it depends on, I think there's two different ways this can go, Anthony. I'm not trying to be evasive here, but I think there's really two different types that could replace Powell, because obviously let's exclude the third option, which is replacing with somebody like him. Not going to happen. So, all right. So you have two options left, I think then. One is going to be somebody who genuinely understands the inner workings of the Fed. And that's going to be, I don't know, maybe somebody like a Kevin Warsh, right? Who wants to shrink the balance sheet pretty dramatically, but also get us back to regular order at the Fed, which is going to mean not just a lower balance sheet, but also lower interest rates. He wants to really go forward on the deregulation front, kind of roll back the clock essentially to where we were, let's say back in like 2006, 2005. Before everything blew up and we made a lot of really bad decisions. So again, putting us back to regular order at the Fed. In a lot of ways, going back to kind of like a Greenspan model where, look, we're going to pay attention to things like the price of gold, for example, and we're going to use a bunch of market indicators to tell us which way is inflation going, how's the labor market doing, not a matter of we're hyper-focused on the financial plumbing and nothing else, which is where we are today. So that's option one. Option two, you get somebody who just basically, doesn't, I think, maybe necessarily understand the inner workings of the Fed, and instead is just focused on, we just got to get interest rates down.
Mhm.
And that's it. And if you're not going to do the reform of the current monetary framework, I mean, you're just setting yourself up for a whole heck of a lot of inflation. And I think the bond vigilantes are going to respond to that by jacking up treasury yields and having exactly the opposite effect of what you want. And by the way, this is what happened in the fall of last year, right around the time of the election, when you and I said the Fed is cutting for political purposes, right? We called it before it happened. And what? How did the Treasury market respond? By hiking yields.
Bonds and yields went up.
Exactly. Because I think investors, the bond vigilantes basically saw this is a political move, and it's not being done for market reasons. It's being done, again, just to get their preferred candidate across the finish line. The result is going to be inflation. Mm-hmm. And to compensate for that inflation, we now want higher yields, right? And that's what happened. And I think that's what will happen again if the next Fed chair is somebody who doesn't really understand monetary policy.
All right. So one word answer, yes or no. Does the market go up? I'm not picking on him because I happen to like him, but does the market have an upward bias if Hassett gets the nod as the Fed chair?
I think virtually anybody, whether it's Hassett, whether it's Warsh, whether it's Bowman, whether it's Waller, whether it's one of the dark horses, maybe. I think pretty much no matter who gets in there, markets are going to rally. Honestly, I don't think there's anybody that markets. Yeah, genuinely, I don't think there's anybody that Trump could appoint where markets would not rally on the news.
Okay, so you didn't hear me say one word answer when I said Hassett. Does the market go up? Anyway.
Yes.
I love you, brother.
Markets only go up. Okay.
So part of the problem, thank you, brother. Part of the problem with the market I see is the casino that it's become. I've been saying this for well over a decade. It is literally, it is a casino. There's no question. And it's gotten worse and worse and worse. So just for 1 second of humor before we go to the chart that I'm going to talk about the S&P since 1925. This is what's out there. This is how these are the quote unquote investors, traders in the market right now. This was posted on X. I thought it encapsulated what the person on the other side of the trade looks like for me. Like, these are the things, and honestly, there's a ton out there with great music in the background. Like, I'm listening, I'm like, I'm in it. They're great, but I'm not at a rave. I'm not out, at a bachelor party. I'm not in Vegas for the weekend. Like, I'm here trying to manage a portfolio of risk assets and make money for my investors. That's why I'm here. People that are posting this stuff, and it's like, to the moon and all the emojis and all the music and this is part of the problem with the hot air inflating the risk bubble and the asset bubble. People that are posting these things are actually pumping money into the market with zero. And I say this respectfully because I don't know them all, but a large majority, anybody that's taking the time to post like disco music to Bitcoin hitting, 10 million, I think they should read a book on fundamental technical analysis versus, figuring out how to edit in.
Assuming they can read,
edit in house music too.
Might want to start with some picture books,
I love
maybe move up to like, Goodnight Moon, something like that.
Where the
baby
wild
steps.
Things are.
Yeah.
So we talk about the market as an utter casino, which it is what it is, but still ways to make money, still ways to manage. And if you have a good model and you stay disciplined, obviously you can make money. If we look at what the market's done, I think the next picture that we have is pretty amazing. So what I've done is just on a straight price chart. We have looked at the S&P. The red bar at the bottom is the S&P from 1925 to 1990. Broad stroke, what do you notice? Well, it's about a 4.9% annualized return over that. And you've had some major shocks there. Remember, you had the Great Depression in there. You had the 1970s in there. You had some real moves in there. 1925 to 1990, 4.9% return, under control. We come off the gold standard in 71 under Nixon. Just remember that mark. So about 20 years later, I stopped the chart. That's when we head into what I consider to be the 90s, the beginning of that. We're 20 years out from the gold standard being removed. US dollar is fiat. And now we have a move into what's becoming the beginning of that tech bubble, right? We're starting to see new technologies develop. We're starting to see the underlying foundation of what will become the 99-2000 tech bubble. From 1990 through today, the annualized return for the S&P over doubled, right? Almost doubled. We're at 9.3% on an annualized rate. So over a 65-year period, initially, we had a 4.9% annualized return. The next 35 years, a 9.3% return. And if you look at this chart, it goes absolutely, I think our chart actually got cut off a little bit here because we're ending in 2009 there. The chart goes absolutely parabolic. We go from literally 321 on the S&P coming out of the 90s, okay, up to 7,000 in the following 35 years. I mean, that move is absolutely parabolic. Why has that happened? We have had valuations out the window. It's different this time. We have had Fed intervention for a large portion of that coming out of 99-2000. That's when I consider the Fed to have started to become the headline that's moving markets. Fed funds rate became a major deal. Liquidity in the market became a major deal. Coming out of 2008, 2009, now we're talking about the plumbing in the financial system, government intervention, Fed manipulation, all of these things. You could also talk about technology and market structure completely breaking down and expanding, breaking down in that it wasn't centralized anymore. It became anyone with a computer or a smartphone could get involved and be pumping money in. So as an individual, no, you're not the size of 0.72 or Millennium. Absolutely not. But as a mass group of global individuals, yes, you have influence in the market. So you've had all these things start to create these parabolic booms and busts in the market. My point is very anecdotal and very broad stroke. Is this sustainable? When you look at this chart as an investor, you have to say to yourself at some point, is it sustainable? If you come up to what is clearly the logical answer, no, it is not sustainable. We have way overstayed our welcome here. Then what does that look like? What's the break that actually breaks this and brings it back to a historic trend, which, by the way, historic trend is easily 50% off of where we are now. Not to be doom and gloom and but that's simply where we would be. What is the headline? What is the change in policy? And what is the magnitude of that move down? That parabolic move needs to reset at some point. Now, does it reset at 7,000 or 10,000? Right now, at this moment, I can't tell you that for sure. I know what I think it should do. I'm never going to position the portfolio on what I think the market should do because I'll be out of business in a month. Now, as we move through and those moves start to develop in the underlying, in the model that I run at Ascalon 6, yes, I hope to be ahead of it as far as long vol, short risk, long goal, however we manage that our positioning in the portfolio. When will it happen? I really can't tell you right now. But what I can tell you is that parabolic move needs to reset. It is the way of the world. It is the universe. We have been artificially pumped to this level, and it has been a great ride for everybody who's owned assets. It's been a horrible tenure for anyone who has not owned assets.
Yeah.
What's the headline and what is the magnitude of that move? Start to prepare for it now, because while it's happening, you are not going to know what to do. Start to think about it now, prepare for it now, or be invested with those that are actually logically looking at the market and the system and able to take advantage of both moves, ups and downs, as we are here. But this is the chart to look at. Very broad stroke, anecdotal right now, but looking back, at some point we will look back at this chart and be like, wow, that was the reset. It is coming. It is coming. And that is the chart for today.
Yeah, Anthony, you're 100% right, as usual. I mean, it's the old adage, right? Anything that cannot go on forever will stop.
Yeah.
And as you said, the question is just when. And you're right, we don't know when. And I think a big reason why is, and anyone who tries to tell you they do know the when is just selling you snake oil. It's because it's not mathematical. It's actually psychological at the end of the day. If you look at, for example, when do countries go bust in terms of their debt gets too big? It's just when people don't believe that they're going to get paid off, and at least in the short term, right? That point of no return. It's not a certain debt to GDP ratio. It's not a certain cost of servicing your debt relative to your national income. Literally, there is no metric for it. It has proven different for all those metrics in different countries at different periods of time in different places around the world. It is actually a psychological phenomenon. And the same thing goes here. When are people going to say enough is enough of my currency losing value? That's when you're actually going to have change. Yeah. And if you look at again, different countries around the world, whether it's what's going on now in Argentina, whether it's what happened in Weimar Germany in 1924, at some point people say enough is enough, and they're willing to put the political pressure on those in charge, or just create a whole new system of government, whatever the case may be. They're willing to enact the change that will change the monetary system. And if you did actually see that change, of course you're going to have a big correction. And then what'll happen? Well, you'll go back to those sustainable rates of growth, like 4%, like you were talking about earlier, right? Let's say you peg the dollar back to gold, and now you don't have the same kind of inflation that you do today. This sustained debasement of the currency, what'll happen? You'll go back to realistic valuations, and you'll go back to realistic growth rates. But until that happens, like you said earlier, Anthony, you're right. If you don't have some skin in the game when it comes to these equities, you are going to be left behind, and you're going to lose your shirt.
Yep, and that's the problem. It's definitely, as we were talking about last time, we live in an asset-based economy, and this is part of that. EJ, I know your X handle I'm on every day, at real EJ Antoni on X. I love it. Everything you're posting up there and you are extremely active there. So for everyone listening, I would encourage you to be on X at EJ Antoni and checking out. You're working on everything from economic releases to growth, to global economic issues overseas. You go through interest rates, you go through consumer debt, everything that's out and could possibly be analyzed or kind of poked at, you're there. So greatly appreciate seeing you there. I am at CMT_Anthony on X. The website is www.ascalon6capital.com. You can go ahead and see me there. You can feel free to email me at anthony.esposito@ascalon6capital.com. Really appreciate everyone joining us again today. EJ, this was a great conversation as usual. You dug in. That breakdown on the Fed was perfect. It's exactly what we want to see as far as markets go. I think we have risk is skewed to the upside, as I've been saying for now, but the expectation of some volatility, and at some point we're going to start to see some longer term signals turn to the downside as this unravels. We'll be on it. We'll be ready for it. But today, EJ, awesome job. Thank you very much, man.
Anthony, always a pleasure. You have a great weekend.